And that closes out the first trading session of this week. Let's take a look at where the markets ended this Monday. All three major indices in the green. We saw the Dow there just sort of tilting into the green in the final few minutes. The Dow up just about 0.25% at 93 points. And you see the S&P 500 also in the green, up about 0.71%, about 32 points. And the tech-heavy NASDAQ, the strongest performer today, up 185 points. That's 1.31%. So to break down how the markets are moving this afternoon, let's bring in our market panel. Nancy Daoud, Ameriprise's Financial Private Wealth Advisor, and Kathy Entwistle, Morgan Stanley's Managing Director. Thank you both for joining us. So Kathy, I want to start with you. As we did see this sort of turn towards the late afternoon for the major indices, what do you think was that turning point? What do you think tipped them into the green in the end?
It could be a number of things. It could have been the conversation that the president had earlier today about his package and what he's trying to accomplish. But what I would tell our clients is we are looking for opportunities to peel some of the growth or the winnings in their portfolio off the table right now. And we're still being somewhat cautious in terms of where the PEs are now and where we might see some of the companies report into first quarter earnings and forward-looking expectations. So to me, today's an opportunity to maybe peel a little bit off the table of the areas that we want to avoid and start adding to the areas that we like a little bit better in this cycle of the economy.
And Nancy, the same to you. What did you see? What opportunity do you see in that late rally to start the week?
I think the volatility was very expected. I think the big issues here is how to fight inflation and keep the volatility in check. The biggest issue the first quarter was, coming to realization of how much inflation are we experiencing and how painful that is. But I say think dividends. Think quality and think total return. We are so used to growth over the last decade that maybe it's now time to adjust a little bit looking ahead.
Kathy, let's talk a little bit more about that quality and the valuations that we're seeing right now, even at current price to earnings ratios. Is that sustainable at this point in time?
Yeah, it's a great question. I would have to say, on one hand, I'm concerned because I do think inflation is already baked into the numbers. So I don't think we have to worry so much about inflation anymore because I think we're considering that into the numbers that we have. But we aren't thinking about like the equity risk premium, and that is the value over, the risk-free rate of return that we're going to get in some of these investments that we make in companies. So I do think that's still an area of concern, but I do like what your other guests just talked about with dividends and opportunities for value. And those are areas that we still like and that we are investing our clients in as well. Things like real estate, healthcare, and utilities should do well in this market environment.
And Nancy, you've talked about the biggest risk for the market being the Fed perhaps making a policy mistake, being too aggressive, raising rates too quickly. How are you positioning yourself then with that in mind?
Well, in the fixed income side or in the bond market, we are still very much in short durations. And I think we have to wait a little bit before we think about longer term durations until we see what the Fed will do next. It's not unlikely that they might have another maybe 50 basis points rate hike in May. But we'll see, what world events bring us. And that seems to be the influencer. I think that once it reaches maybe north of the 10-year Treasury, once it reaches more than 3%, we might consider looking at some opportunities in the bond market as well.
Kathy, do you see a 50 basis points increase at the next meeting? And what would be too fast for the Fed?
Yeah, I think the issue was they waited too long in the fourth quarter of last year, calling everything transitory. So now it's like the catch up. No, we're expecting pretty aggressive numbers. 50 basis points the next two meetings, and then some 25 basis points after that. So that is what we're expecting. In terms of fixed income, we're also staying short, but we're also looking at long treasuries as an opportunity for a hedge right now.
Nancy, it sounds like, based on your notes that I'm reviewing here, you believe the same, especially with the impact to inflation and how that may persist a bit longer because of the Fed not getting ahead of it soon enough. And so with that in mind, what are you anticipating in terms of the aggressiveness of the Fed, not just at this next meeting, but even further out into the year, as they're already looking for, at this point in time, some of the inflation not to cool, or the rate of inflation growth that we've seen not to cool until the back half of this year?
Well, it all depends on how fast they go with this and how aggressive they are. If they end up tapering back again to 25 basis points instead of 50, then it's going to take longer. If they get more aggressive, I think the key there is if they go too fast and too much, that will change things dramatically for the market. But as long as they do it methodically and prudently, then I think that's all already baked in.
Nancy Daoud and Kathy Entwistle, we appreciate you both. Thank you.